Okay, let's unpack this. For many of us, it's that annual administrative hurdle, right? A towering stack of papers, or maybe just a really confusing interface on a government website. It is the mandatory annual moment of financial reckoning. We are diving deep into the architecture of the tax return.
It is indeed mandatory, and that is precisely why it is such a powerful document.
Right.
The tax return, at its core, is the essential mechanism that authorities all over the world use to determine your tax liability. It is your formal legal declaration of your entire financial universe for a given period.
And our mission today is to turn that intimidating stack into clear foundational knowledge. We want to equip you, the learner, with a thorough understanding of the core mechanics, the components, income, deductions, credits, and critically, the astonishing differences in how different nations manage this liability calculation.
We're cutting through the jargon.
Exactly. We're giving you the blueprint.
And to start, I think we have to acknowledge just how universal this process is, even if the names change dramatically from place to place. The function of assessing and collecting revenue, that's present in every developed economy.
So when we talk about these institutional bodies, we're talking about the Revenue Service.
Precisely. In the United States, that's the Internal Revenue Service, the IRS.
Yeah.
But you go to the UK, it's Revenue and Customs.
Okay.
And in China, you have the State Taxation Administration. Every single one of these entities relies on citizens and organizations providing this detailed financial account to function. The tax return is really the foundational civic paperwork of the modern state.
So if it's the foundation, let's start at the very beginning. If the tax return is essentially a formal letter to the government, what is the crucial information we are legally required to put in that letter? What goes into the thing?
Well, the return is a highly structured document. It's designed to capture, let's say, 4 primary categories of financial information. First, of course, is your income, all sources of revenue you received. Second, your expenses, or maybe a better term, is allowable deductions, which reduce that income figure.
Got it.
Third, it tracks any tax payments you've already made during the year, which is mostly through withholding. And finally, any other relevant information specific to your circumstances, be that foreign bank accounts, specific asset sales, changes in family status. It's the full ledger that lets the authority perform the final calculation.
And for so many people, especially wage earners, that final calculation boils down to a very immediate and personal question. Do I get a cash refund, or do I owe the government more money?
That's the most visible outcome for sure. The immediate function for individual taxpayers is determining that tax refund or final payment. And the refund equation is, in theory, elegantly simple. It just depends on whether you have overpaid taxes throughout the year.
So if my employer withheld too much.
Exactly. If you had, say, $12,000 withheld from your salary over the past year, but your final calculated liability is only $10,000, you are due a refund of $2,000.
And the other way around.
Conversely, if your liability is $12,000 but only $10,000 was withheld, you owe the difference. The entire return is just the mechanism to settle that debt or, retrieve that overpayment.
That makes perfect sense for most employed people. But here's a point of confusion for a lot of our listeners. Do you always have to file a tax return? What if I worked a minimum wage job for 3 months and then took the rest of the year off? Do I still need to submit a form?
And that is where the rules diverge significantly by jurisdiction, but generally, no. Filing is not always required.
Okay.
The necessity usually hinges on an income threshold. Governments establish minimum gross income levels, basically saying that if you earned below this amount, perhaps because you're a student or you only worked part-time, your tax liability is likely 0, and a formal return isn't strictly necessary for them to collect revenue.
So if I earned, say, $5,000 last year, the threshold in my country is $12,000, I'm technically off the hook.
That's the starting point, yes. But we must immediately introduce some complexity here because other factors play a vital role all over the world.
Of course.
Your age is critical. Many countries, including the U.S., offer higher thresholds for older citizens, which reflects the reality of retirement income or fixed resources.
I see.
The type of income is also paramount. Passive investment income or freelance income, what's known as Schedule C income in the U.S., that often triggers a mandatory filing requirement even at much lower levels than traditional W-2 wages.
Okay, so it's not just how much, but how you earned it.
Precisely. And finally, your filing status, whether you file as single, married filing jointly, or head of household, that drastically impacts that required minimum threshold.
Speaking of complexity, let's compare that to a system like the UK's, which you mentioned earlier, HM Revenue and Customs. Don't millions of people in the UK never file a formal return at all?
They don't, and that's a crucial global contrast. The UK operates on a vast pay-as-you-earn, or payee system for most employees. The withholding mechanism is so robust, and the government's access to data is so comprehensive that the tax authorities can often calculate the final liability perfectly throughout the year.
Wow.
So for millions of single-wage earners with simple finances, the tax deducted from their paycheck is the final tax liability. They get a summary statement, but they never have to interact with a return form.
That is a staggering difference in the compliance burden.
It's night and day compared to systems where almost everyone must submit a return, even if their liability is zero.
So let's go back to that U.S. model for a moment and this intriguing exception that was mentioned in our sources. Filing a return even when you're not required to. Why on earth would anyone voluntarily take on that administrative burden?
It comes right back to that refund equation we talked about. This is a really crucial strategic point for our listeners. If you were legally not required to file because your income was below the threshold, but you still had tax withheld from a paycheck, maybe $500 was withheld before you quit that short-term job, that money is currently sitting with the government.
And they're not just going to send it back automatically.
Absolutely not. The only mechanism to prove that $500 is due back to you is to file a return, even if the income section shows you have zero liability. Filing, in this scenario, is purely an act of financial reclamation.
So it's basically a required receipt to get your own money back.
That's a perfect way to put it.
Okay, so you file the document, either because you had to or because you want your money back. Does the government just accept the numbers we provide, or is our tax return simply the start of a conversation?
It is absolutely the starting point, not the definitive endpoint. And this is a critical legal and mechanical distinction. The source material really emphasizes that the tax return you submit is not necessarily the final calculation.
It's your version of the story.
Exactly. It is your assertion of your liability. The government authority, be it the IRS or the State Taxation Administration, retains the full power to review, audit, and ultimately to accept or not accept the return as correct.
So if I use some tax software and it spits out a number saying my liability is X, that's not binding.
Correct. The software is only calculating based on the data you provide. The government, however, has access to third-party information records from your employers, your banks, your investment houses.
So they can cross-reference.
Instantly, if their internal systems detect a mismatch, say your bank reported $5,000 in interest income, but you only reported $500, they will send you a notice. Your filing is an invitation for that review process. They are the final arbiters of the tax law.
We've established that the tax return is this universal, essential document, but now we need to talk about the cost of managing it. We touched on a statistic earlier that is truly staggering, and I think we need to spend some serious time unpacking it. The global average time spent on compliance.
That figure is the hook that frames this entire deep dive. Nearly 232 hours is the average time spent globally to prepare and pay taxes.
232 hours.
And this isn't just the few hours you spend inputting numbers into a computer. This includes the time spent organizing receipts, learning the tax code changes year to year, seeking professional advice, managing audits. It's everything.
232 hours is almost 6 full work weeks. Imagine telling a small business owner that a significant percentage of their administrative year is just consumed by compliance with the tax code. Why is this figure so incredibly persistent? Why hasn't technology made a bigger dent in it?
Well, the complexity really stems from two main areas. First is what you could call regulatory churn. Tax laws are rarely static.
They're always changing.
Every single year, every new policy initiative, a new credit for green energy, a change in capital gains treatment, it adds another layer of complexity that has to be learned and implemented.
Okay, so that's one part.
The second is documentation and substantiation. If you are a freelancer or a small business, tracking deductible expenses, your mileage, office supplies, business meals, depreciation, it requires meticulous ongoing record keeping. It is the need to be able to defend every single number entered on the return that drives that compliance time up so high.
And that connects right back to what we were saying earlier. If you want to itemize your deductions, you need all that supporting documentation.
Right.
That means I have to file and retain hundreds of receipts just in case. That's where those 232 hours of human time are being absorbed by bureaucracy.
It is a monstrous economic drain, and recognizing this cost of compliance, many governments are pursuing massive simplification efforts. The main strategy is leveraging technology and, crucially, data transparency.
How does technology move beyond just, letting me type my numbers on a screen instead of writing them on a form?
So the initial step was electronic filing and payment systems, the e-filing that keeps track of your history and so on. But the truly game-changing development is the dramatic increase in intergovernmental data sharing.
What does that mean in practice?
It means that financial institutions, employers, investment firms, mortgage companies, they're automatically reporting your income, your interests, your payments directly to the Revenue Service before you even begin filing.
So the government already has all my W-2s, my 1099s, and all my interest statements, which are the standard U.S. forms for reporting income. They have them before I even log on.
Precisely. The data is pre-populated on the government side. This shift from citizen reporting to third-party reporting is the foundational technology that allows us to move to the aha moment of this whole thing.
Yeah.
Return-free filing, which is exemplified by the Nordic model.
This is where the story gets really interesting. We're talking about a paradigm shift where the government is the one doing the 232 hours of work. Tell us about this return-free filing concept in places like Denmark and Sweden.
This model just flips the traditional dynamic on its head. Instead of the citizen being the author of the tax return, the government becomes the primary author. Because they have robust data sharing and, high social trust, governments in several European nations actively calculate the tax liability for the vast majority of their citizens.
So what does the taxpayer actually do in Denmark then?
They receive a prefilled return form. This form already contains their salary, known deductions like mortgage interest payments, and the estimated tax owed. The citizen's job is reduced from preparation to mere verification.
Just checking their work.
Exactly. You look at the form, and if it's accurate, which it is for most simple filers, you confirm it. Sometimes it's as simple as an SMS text message or a click in an app. If you have complex, unknown variables like freelance income or new deductions, then you edit the form or file a traditional return.
That is the ultimate goal, isn't it? Reducing a 6-week annual headache down to a 5-minute review.
And we have decades of successful data on this. I mean,
Yes.
Look at the figures from 1999, which is ancient history in terms of technology. In Denmark, a staggering 97% of all taxpayers utilize these pre-filled forms. Sweden saw 74%. This wasn't some fringe option. It was the mechanism of choice for the overwhelming majority. It just goes to show that the 232-hour global average is a factor of system design and complexity, not an immutable law of physics.
That contrast really does frame the entire debate around tax administration, doesn't it? The Nordic model achieves this by mandating that almost all financial institutions report data directly and comprehensively, creating an environment of high data quality and, crucially, high trust between the citizen and the state.
That trust is paramount. The system only works because the citizen trusts that the government's prefill is likely correct, and the government trusts that the citizen will correct any deliberate errors. It is a massive institutional investment in efficiency, designed specifically to reduce the citizen's cognitive and administrative burden down to the lowest possible level. This is the model that shows how we could potentially eliminate the vast majority of that 232-hour compliance cost.
Okay, now that we understand the process and the compliance costs, let's get into the mechanics. The liability is determined by 3 core variables: income, deductions, and credits. These are the levers you pull to determine your final bill. Let's start with the foundation, defining what actually counts as income.
When we define income for tax purposes, we're aiming for comprehensive coverage. It encompasses all sources of revenue, cash, property, services that you receive during the year, excluding only those very few items specifically exempted by law. It's a very, very wide net.
What are the primary revenue streams that absolutely must be reported?
Well, the obvious ones are wages and salaries. If you get a W-2 form from a U.S. employer, that is your primary income report. But it goes far beyond the regular paycheck. You also have to account for income from retirement plans, like 401k distributions or pensions.
Okay.
Dividends you receive from stock investments, interest earned on savings accounts, and crucially, capital gains or losses realized from asset sales.
Let's pause on capital gains for a moment, because that's often confusing jargon for people. What exactly is a capital gain?
A capital gain is the profit you realize when you sell an asset like a share of stock, a piece of real estate, or sometimes collectibles for more than you originally paid for it.
Simple enough.
If you bought a share for $10 and you sold it for $15, you have a $5 capital gain that may be taxable. A loss occurs if you sell it for less. And tax systems worldwide treat capital gains differently than ordinary wages. Often they're taxed at a lower rate, especially if you held the asset for a long period of time.
And that distinction is crucial in a system like Australia's, right?
Right.
Where how you derive the income is highly relevant.
Very relevant. And that brings us to the pivot point. Taxable income. We've defined gross income, the total amount that came in the door. What is taxable income and why is it so important?
This is the number that really matters.
This is the number that matters. Taxable income is the core figure upon which all tax rates are applied. It is the amount that remains after all of your allowable deductions have been subtracted from your gross income. In effect, it's your true adjusted financial ability to pay tax.
And as we noted in the sources, the Australian system highlights just how central this calculation is.
That's right. While many systems emphasize gross income first, in Australia, the concept of taxable income is the central metric used to determine the final income tax liability. You start with income, you subtract specific expenses, and the result is the number that gets slotted into the progressive tax brackets. The entire complex dance of filing is dedicated to successfully whittling down that gross figure to the precise taxable figure.
Legally minimizing the amount subject to tax.
Exactly.
So let's discuss the first major tool we use to whittle down that base. Deductions. What is their fundamental purpose?
Deductions are items subtracted directly from your income. Their function is explicitly to reduce the income that is subject to taxation. So if you have $100,000 of gross income and $10,000 in allowable deductions, your taxable base drops to $90,000. You are effectively removing that $10,000 from the progressive tax schedule.
And this concept applies equally, though.
Yeah.
Differently to both corporate and individual filers, I assume.
Absolutely. For organizations, the deduction concept is much broader. Most expenses specifically identified with the cost of doing business rent, utilities, salaries paid to employees, they're all deductible. If a business needs to spend $1 million to earn $1.1 million, only the $100,000 profit is typically taxed.
But for individuals, the rules are much tighter.
Much tighter, and they're often aimed at encouraging specific societal goals.
What are the most common individual deductions that our sources cited?
3 major categories appear frequently. First, mortgage interest, which is a powerful incentive for homeownership. Second, student loan interest, which incentivizes education. And third, contributions to specific retirement saving plans, encouraging long-term personal financial planning.
So by making these things deductible, the government is giving you an incentive to spend money in these socially beneficial ways.
That's the policy goal, yes.
Now, when taxpayers approach this section, they often face a fundamental choice that really defines the rest of their filing experience. Standard deduction versus itemized deduction. This is the fork in the road.
It is the single most critical decision you'll make in this part of the process. The rule of thumb, regardless of country, is that your taxes paid will generally be less when you choose the larger of the two. You have to crunch the numbers for both.
Describe the standard deduction for us. What is that?
The standard deduction is a fixed, established amount set by the government based solely on your filing status, single, married, and so on. It provides simplification.
Right.
Millions of people don't have to keep a shoebox full of receipts because the government gives them a substantial default deduction automatically. It's also higher for older taxpayers, specifically those 65 and above in the U.S. system, acknowledging their distinct financial situation, which often involves high medical costs.
And if you choose the itemized deduction path, you are effectively betting that your specific personal expenses add up to more than that easy standard amount.
Precisely. If you are itemizing, you are saying, my unique documented expenses are so high that they exceed the default standard deduction. And this is where the complexity spikes and where the Schedule A form comes into play in the U.S. system.
Let's go into Schedule A. If I choose to itemize, what types of expenses am I aggregating here? And why does this form add so much to that 232-hour global average?
Schedule A is where you aggregate all those specific expenses. Key categories include medical and dental expenses, but only the amount that exceeds a certain percentage of your income.
So not all of it.
Not all of it. Then you have state and local taxes, which are capped in many places, and charitable contributions. The reason it consumes so much time is documentation. If you claim $5,000 in charitable contributions, you must retain the official receipts and acknowledgement letters from the charity.
You need the paper trail.
You need the paper trail.
Oh, yeah.
If you claim a deduction for medical expenses, you need all the statements showing the payment. The itemization process is inherently document-intensive, which is exactly why the simplification model of the standard deduction exists in the first place.
Okay, so if deductions reduce the base, we now turn to what you call the most powerful tool in the tax system, tax credits. We cannot overstate the difference here. This is the ultimate takeaway for the listener.
This is the concept that really differentiates a casual filer from an informed taxpayer. Deductions reduce your taxable income. Tax credits directly reduce the actual amount of tax owed to government entities.
They're dollar-for-dollar reductions of the final bill.
Exactly, a dollar-for-dollar reduction.
Let's use a concrete numerical example to illustrate this power, because I think it's often misunderstood.
Okay, let's say your final tax liability, the amount you actually owe after all the deductions, is $10,000. Now consider two scenarios.
All right.
Scenario A, you find an additional $1,000 in allowable deductions. If you're in the 25% tax bracket, that $1,000 deduction saves you 25% of $1,000, or $250. Your tax bill is now $9,750.
Okay, so you save $250.
Right. Now, scenario B. You qualify for a $1,000 tax credit. That $1,000 is subtracted directly from the tax owed. Your $10,000 bill is reduced by the full $1,000. Your tax bill is now $9,000.
A credit of $1,000 saves you $1,000. A deduction of $1,000, in this case, saves you only $250.
That's it.
That's why credit is so much more impactful.
Yeah.
It reduces the price tag itself, not the size of the bucket you're taxing.
Exactly. And this power makes tax credits a preferred tool for governments enacting social or economic policy, because the benefit is often felt more equitably across income levels. A deduction benefits high earners who are in high tax brackets more than low earners. A $1,000 credit benefits everyone equally with $1,000 of savings.
So where do these valuable credits typically come from? What are they tied to?
They arise from very specific policy incentives. The source material gives some excellent examples. The child tax credit is common globally, offering direct relief if the taxpayer cares for a child, often defined by an age limit, for instance, under the age of 13 in the example cited. It directly offsets the costs of child rearing.
And we also see credits tied to education, like the American Opportunity Tax Credit.
Correct. Education expenses are often incentivized through credits rather than deductions because the government wants to ensure maximum impact for citizens who are investing in higher education. Other credits might involve energy efficiency upgrades to your home or specific business investments. They are targeted instruments designed to change or support behavior by offering the most powerful tax relief available.
So we've covered the three big components, but we know the reality of complex filing involves a massive volume of supplementary documents. We need to dissect the purpose of these so-called tax schedules, which are what push that compliance time up toward that 232-hour global average.
The tax schedule, particularly in the U.S. system, is the mechanism that handles complexity. A tax schedule is an additional form required by the IRS in addition to the main Form 1040.
Why do they exist?
They exist because you can't calculate, say, the profit from a small business or the gain from selling stock on just one line of the primary return. It's not possible.
So what's the function of these separate documents?
They're essentially computation tools. They act to report and provide detailed information about supplementary calculations and specific amounts. For example, a Schedule C might require 50 lines of expense input to arrive at one single-figure net business profit, which is then carried over and summarized on one line of the main 1040 form.
So they provide the necessary auditable detail, the backup math.
That's it, the backup math.
So the complexity of a person's financial life directly determines the number of schedules they need to complete.
That's it, exactly. A simple return, W-2 income, standard deduction, no investments, that might only use the Form 1040 itself. But as soon as you step outside that simple box, you begin accumulating schedules, and that rapidly increases the time burden and the risk of computational error.
Let's give the listener a specific breakdown of what a few of these schedules actually require you to calculate, because I think that's where the 232 hours are really spent. We've already mentioned Schedule A for itemized deductions. What about some of the others?
Okay, let's look at three critical examples that dramatically increase complexity. First, Schedule C, profit or loss from business. This is for sole proprietors, independent contractors.
The gig economy.
The whole gig economy lives on Schedule C. To fill this out, you must calculate your gross revenue and then meticulously track and subtract every single business expense. Supplies, advertising, equipment depreciation, home office use, business mileage. This requires detailed logbooks and calculations, the very essence of that compliance time.
Okay, that sounds like a lot of work. What's another big one?
Second would be Schedule D capital gains and losses. If you sold stock, property, cryptocurrency, you use this. It requires calculating the exact difference between the sale price and what you paid for it, the basis, and then tracking how long you held the asset, short-term versus long-term, because those rates are different.
And that can be complex because you might have to track transactions going back years.
Decades, sometimes. And a third one is Schedule SE, self-employment tax. This is mandated for those with net earnings above a very low threshold. It ensures that self-employed individuals pay into Social Security and Medicare equivalents, which is normally covered by an employer's matching contributions for W-2 workers. This form requires specific multiplication and proportional calculations based on your Schedule C net income.
So it becomes really clear that managing these other financial activities, running a business, trading stocks, it doesn't just increase your potential tax liability, it increases the administrative cost of filing exponentially.
It connects directly to that global average. Each new schedule you add requires specific knowledge of tax law and meticulous record keeping, which is precisely why countries using the return-free filing concept struggle to automate the returns of people with complex business or investment income. The government simply can't know all those details without the citizen's manual input.
So once all these schedules are complete and we've arrived at the final liability, we need to finalize the conversation by defining what the government already has: payments.
Payments refers to the money the revenue service already holds on your behalf. This primarily consists of two things: the amounts withheld from your regular paychecks by your employer, and any estimated tax payments you are required to make throughout the year.
Which is typical if you're self-employed.
Right, if you were self-employed or had significant investment income, you'd typically be paying quarterly.
And finally, that brings us back to the reconciliation loop, the final settlement.
Exactly. The final settlement process is simply comparing the total tax liability figure, calculated after applying all your deductions and credits, against those payments already made through withholding and estimates. If the payments exceed the liability, a refund is issued. If the payments fall short, the remaining amount is due immediately to the government. The accuracy of the return determines the final outcome of that entire financial year.
So what does this all mean? We started by looking at a ubiquitous piece of paperwork, and we ended up navigating this philosophical conflict between complexity and automation. We've seen that the tax return is the foundational legal mechanism that requires, on average, 232 hours of effort globally. And that effort is primarily driven by the need for supporting documentation and complex calculations laid out on forms like Schedules C and D.
We hope that you internalize two primary concepts from this deep dive. The first is just the sheer economic drag that's caused by regulatory complexity. The second, and perhaps the most crucial for optimizing your own financial strategy, is that definitive, powerful distinction between the two ways to reduce your tax burden.
Let's nail that one last time. Deductions reduce the taxable base. They chip away at the income figure before the tax rate is even applied.
And credits reduce the tax owed. They are a direct dollar-for-dollar subtraction from your final bill.
Understanding that relationship is foundational to understanding the mechanics of any tax system, regardless of whether you are filing in London, Beijing, or Washington.
And this brings us to our final provocative thought. We spent a significant amount of time contrasting the complexity that requires meticulous paperwork, those schedules, that 232-hour effort, with the automated return-free filing systems used in the Nordic countries, where citizens largely just verify prefilled data.
Right. Technology and data sharing clearly promise a future where those 232 hours are all but eliminated, where filing is simply clicking confirm on a notification on your phone.
But consider the trade-off. If the system becomes completely invisible, purely automated, and the government does all the math for you, are we losing a crucial connection to our own civic life? Does being forced to itemize your deductions or to calculate your Schedule C profit make you acutely aware of how much you're actually paying and therefore more engaged with how the government is spending that money? If the process of taxation becomes utterly painless and invisible, does it potentially reduce the citizen's critical engagement with the cost of governance? That profound trade-off efficiency versus awareness is what the future of the tax return really hinges upon.